It is great. Great. Hello. It's great to see all of you here in person. This is a small gathering and also a small room, so it feels very intimate, which is what we wanted. And I'm going to go ahead and get us started with our special guest here. So first of all, I just want to say welcome to Ginnie Mae. It's great to see all of you here in person. And again, thank you to all of you for being here. Thank you to our wonderful, esteemed past presidents of Ginnie Mae who are with us today. And I want to thank Secretary Fudge for being here. First visit to Ginnie Mae of hers. And I cannot thank her enough for her leadership, for her vision for HUD, her unwavering support of Ginnie Mae and what we do, and her confidence and acknowledgement of us and the essential role that we play in America's housing finance market, which has been clearly stated in the 5-year plan, strategic plan that was just released a few weeks ago. So I'm really pleased to introduce Secretary Fudge to Ginnie Mae. She's going to open up the program for us very quickly. She is the 18th secretary. She joined the Biden-Harris administration just a little over a year ago. And she has undoubtedly been the best thing at the right time that could have ever happened to HUD. And it has been an honor and a privilege, Madam Secretary, to serve alongside you. So without further ado, I will introduce you. Thank you so much. Thank you.
Thank you very, very much. This is my first time, and I'm probably not coming back because these offices are so much nicer than mine. It's like I walk in and I said, Elaine, I'm in the high red district. But I am so very pleased to be here with you all. I consider myself a leader of leaders, and certainly your leader is one of the people that I have such high regard and respect for. I'm so happy to co-host this with you. Everybody knows how I feel about you, and you couldn't be in better hands than in Elena McCargo. So thank you, Madam President, for having us. And to these past presidents, 2 of whom are from Ohio, so I've just decided Ohio is really the heart of it all. Thank you so much for being here. You know, from the time you all started, Ginnie Mae has gone from about 50 million to over 2 trillion. Huge. And I can't say that it was solely because of each one of you individual, but collectively, you moved Ginnie Mae a very, very far distance in a very short period of time. So I thank you all as well. And I thank you for being here. It's hard to be a public servant. It takes more time than people think. People take for granted the work you do, but certainly I don't. And again, I thank you. And to all the staff here, you make it happen. I don't try to tell anybody what to do when I know I have the leadership that I have here. But what I do want you to know is that I appreciate you. I appreciate the work you do every day. Director Thompson, President McCargo, I could not do my work without your input and without your partnership. So thanks, everybody. I know that this is going to be an outstanding event as we talk about how we move forward and some ideas you have and some things that you can talk to us about that you did in the past that were successful. I'm going to take my leave, but I just wanted you to know that this was so important to me today to be here to say thanks to everybody. Thank you so much.
So again, thank you all for being here. My name again is Elena McCargo. It is my distinct honor to be the 18th president of Ginnie Mae, sitting alongside 40 years of Ginnie Mae presidents plus. It's just a really exciting day, and it's great to bring you all together, and I really appreciate you all being here today. This afternoon, we're launching the first of a series of Ginnie Mae events that are going to really illuminate our plan to meet the ambitious goals that have been outlined in HUD's strategic plan, which will be translating into Ginnie Mae's new strategic vision and operating plan for the future. We intend to air this intimate conversation that we're going to have today on our Ginnie Mae podcast. It's a podcast that we update every month with really timely information on the market, and we will be sharing this more publicly as we have such a small group here of staff and friends in the room. As an agency, we have a rather huge task ahead, and we're all sitting in a moment where we are looking back a few years at unprecedented growth during the pandemic, where the housing system is also looking forward at what is new headwinds and new market dynamics that are facing us. The team at Ginnie Mae is working to make sure that our guarantee remains a valuable source of liquidity and stability for stakeholders, and that we continue to protect taxpayers and manage the many old and new risks that we face as an organization. We are engaging and listening to stakeholders from all parts of the housing finance ecosystem right now. That has been job one for me since I arrived in January. Speaking to and learning more about the team and the staff. The team at Ginnie Mae, since many of you were here, has grown two- and threefold. We have nearly 200 employees. And we have also, again, embarked upon a real external stakeholder engagement and discussion and conversation with many of you who are here in the room. I wanted to, in my way of introducing each of you, you've each kind of during your tenures faced different challenges and experienced different milestones during those times when you were here. Some of you have seen significant financial upheaval. You've seen explosive growth. You've seen incredible transformation, how our issuer base turned from savings and loans to banks to now predominantly independent mortgage banks. We are looking ahead at another cycle of change in the housing market, and one of the key aspects of our strategic plan at Ginnie Mae for the future is our commitment to transformation. Business transformation, technology modernization, digitalization, and a focus on equitable housing finance system that serves the current and future needs of all of our citizens, our senior citizens, our service members and veterans, first-time home buyers, in cities, rural communities, tribal lands. We are here to make sure that our guarantee and the program remains viable. President Biden has made clear his commitment to housing America and ensuring an equitable path forward. And so our mission is to connect capital from around the globe to local communities. And we make sure that liquidity is there and that affordable home ownership and quality rental housing access is available through the FHA, VA, tribal, and rural programs across government. I'm going to start with talking a little bit about each of you. We're not exactly in the order, but I'm going to go in a certain order, and it'll probably make sense at the end. One thing, as we talk about the headwinds we're facing, inflation is one example. Inflation's on the rise today. This is not a new thing, but when Secretary Dalton, for example, was leading Ginnie Mae starting in 1977, this agency was a steadfast partner to the industry, mostly savings and loans back then, and a consistent source of capital even when mortgage rates were hitting nearly 13% in your tenure. How'd you do it? I think we want to know what your strategy was. We want to know what you learned through that period of inflationary growth and high interest rates. We are in a moment now that feels very familiar, and that we're looking forward to hearing what you have to say about that. Ron Rosenfeld, from 2001 to 2004, you took over at the turn of the century, of the 21st century, a time of tremendous optimism. The internet was taking off. And transforming how we did business, especially in the mortgage market. The 30-year rate was considerably higher in those years. Technology systems were not nimble. No, I'd argue that they may still not be as nimble as they need to be today. And yet Ginnie Mae prospered, grew, and fulfilled its mission under your leadership. Rob Couch, some would say, was here just as the storm was brewing. I mean, you may have not even realized it for some of those years. In 2000,
he bailed.
Yeah, right. And then he bailed. 2006, 2007, and then we moved. So it was the peak of home ownership boom. You were in boom time. 69% home ownership rate we reached as a country, and we saw Black and Hispanic home ownership rates going up, and really seeing the FHA program being a major contributor to that. I'm sure you have some ideas that you can share with us about what you saw in those times, and we're looking forward to a spirited conversation with you on that. And then Joe Murin came during the crisis. You led the organization through the Great Recession and another period of explosive growth. And in so many ways, Ginnie Mae MBS were the only game in town during Joe's tenure. About $488 billion of Ginnie Mae MBS were outstanding in May 2008. And by the end of 2009, that had nearly doubled to $880 billion. So this was what it was like to practically have, we're really excited to hear how you endured and what you did during that time of explosive growth. And finally, last but not least, Mr. Tozer, Ted Tozer, some people have referred to you as the $1 trillion man. During your 7 years at the helm of Ginnie Mae during the Obama administration, the last time Ginnie Mae had a Senate-confirmed president in place before I arrived, the portfolio reached $1 trillion for the first time during your tenure. It has been incredible, some of the programs and ways that you work to adapt, and you were really at the forefront of the change and transformation of the issuer base, going from banks being healthy and a healthy part of the program to a very, very dominant, independent mortgage bank dominated Ginnie Mae, which we still have today. So I'm going to moderate this conversation today. I look forward to hearing from all of you. I'm going to ask one question to get us going, and then I'm going to turn it over to you all. Selfishly, I just want to say this is a unique opportunity to sit here with many, many decades of experience in different market cycles. I intend to learn from everything I hear from you. I am grateful to all of you, those of you that reached out to me during my confirmation process and really just lended a supporting hand and let me know that you were there and you had my back. I really cannot tell you how helpful that was during this process. So I will start with this one question and then we'll go around. I described a little bit about what was happening during your tenures as I just opened, but can you spend 2 minutes each just talking about what some of the most important relationships and aspects of the market you had in focus during your time as Ginnie Mae president? Was it the Treasury Secretary? Was it HUD Secretary? Was it something else? What were the most important relationships that helped you get through that period of what it was that you were enduring during that time? Secretary Dalton, do you want to start?
Sure, I'll be glad to. Thank you very much for being here and for helping us celebrate our time with Ginnie Mae. I really cut my teeth on Ginnie Mae, and it was such a great experience. I loved it. I loved the job, and this was when Ginnie Mae was new. I mean, I was the 4th president of Ginnie Mae. Woody Kingman was the first, and David DeWilde preceded me, and they both did a fine job. But we were introducing the marketplace to Ginnie Mae, and it was a sales effort to make investors aware of Ginnie Mae's certificate. And I was speaking at one group and telling all the virtues of Ginnie Mae's certificate, how it was full faith and credit of the government was behind it, how they paid higher rates, and the liquidity was something. And I said, if I weren't president of Ginnie Mae, I would invest heavily in Ginnie Mae's certificates. And one wise guy in the back said, if you weren't president of Ginnie Mae, I would invest heavily. So it was not all smooth sailing. But I enjoyed the job very much, and it was we passed the $50 billion mark that the secretary talked about, and it was a great time.
Yes, I mean, you literally were knocking on doors, knocking on doors. I think it's great. How about you, Rob?
Well, the question was what are the most important relationships? And I would say the people in this room are the most important relationship. They're the folks that do it day in and day out and know where the bodies are buried and where the opportunities are. Not having worked with Secretary Fudge, I won't disparage Secretary Fudge. I won't disparage any of the secretaries I work for. But there were some folks who said the best way to be a good Ginnie Mae president was to stay away from the HUD building. Now, I don't know if there's any truth to that. But John speaks the truth here. The whole mission, the whole idea. I think we all are in this room would agree that home ownership is a very, very important opportunity for people in this country. We've seen the statistics. The family that owns their home the net worth of that family is roughly 30x the family that rents a home. It's the most effective way. Some would argue with me about education, but it is a very effective way to shrink the wealth gap, so we need to focus on it. A very important aspect of that is an efficient secondary market. In order for homeowners to get the lowest possible interest rate, the mortgages need to be marketable. And all of the Ginnie Mae, all the mortgages that are in Ginnie Mae securities have some form of guarantee of the federal government, FHA insurance or VA guarantee or rural housing. But the secondary market really appreciates the timely payment of principal and interest, and that's what a Ginnie Mae guarantee does, is guarantee the timely payment of principal and interest. And so that's Mecca. John mentioned the full faith and credit of the government. I was, I think, the first Ginnie Mae president to go to Asia and try and convince some of the fiscal and monetary folks to take a look at Ginnie Mae's, and I was told at the time that they were fine and happy with other agencies that shall not be named here. And because they had the full faith and credit of the federal government. I said, no. Ginnie Mae has the full faith and credit. Well, it turns out I was wrong, but that's as we've seen. But it is a very vital role that Ginnie Mae plays, and without the folks in this room, it couldn't be done the way it is.
I could not agree more. Mr. Rosenthal.
I can respond to that question by telling you how I began at Ginnie Mae. I was actually sworn in on September 10th, 2001. The following morning, after my swearing in, was a very important day. I showed up at Secretary Martinez's office wanting to be a good new employee at about 8:45. I was there a couple of minutes. The TV was on, and the World Trade Center had been hit. Immediately thereafter, the Secret Service rushed in, grabbed Martinez, took him out. They did nothing for me, said nothing for me. So I would suggest that you enhance your relationship with the Secret Service. That's number one. Number two, if you think about it, you would realize that we had some payments due after the 11th. Now, how the hell do you make payments when the money flow wasn't functioning? Well, talk about making friends. Our people went over to the Treasury Department and said, hey, we got payments to make. The money's not flowing. We need help. And we got it. All right, they covered our back. We never had an issue in terms of with the payments we made on, I guess, the 14th or 15th or whatever it was. So that was a very important relationship. The other relationships that I had, which are perhaps a little unique to me, that was a period in time when other countries wanted to enhance their home ownership. They wanted a secondary mortgage market. I wound up spending, believe it or not, a good deal of time in Russia with their housing finance people and so on, as well as in Mexico. Those were extraordinary experiences. I'm sure they would certainly not occur today, but I think if I were to give you or give Ginnie Mae some advice about relationships, I would respond out of a totally different context. And that is, some years ago I was asked to give called the Traphagen Lecture at Harvard Law School. I went to Harvard Law School. I never practiced a day in my life. But anyhow, they invite me back. I do have my name on a few walls, but I make a long story. They invite me back to give a lecture to the third-year class. And I said, great, I'll be there. And then it occurred to me, what the hell do I say to them? Yeah, I never practiced a day in my life. I don't know anything about the law world today. I graduated 50 years ago. What am I going to tell these people? And I said to myself, I'm going to give them some investment advice. And the investment advice was, be nice to people. And I say that because I'm 83 years old. The joy in my life that I've been able to have recently in the last 10, 12, 15 years has become solely from the fact that someplace along the line I was nice to somebody and they remembered that. Now, why do I say that in the context of Ginnie Mae? Because you're in business. You're here because somebody comes to you to do something in one way or another. And my advice to you is be as accommodating as you can, be as helpful as you can. And not only are you enhancing your business, you're helping America. You're helping America meet a very important need. So, I'm sure you don't need me to tell you, but Madam President, I tell your people, be nice to people.
Yes, I'm wholeheartedly 100% endorsing that one. Thank you for that. And I'm going to ask Ted, and then we'll come back to Joe.
Again, you talk about the people most involved. Again, I was the most blessed person in the world to have the people that worked for me, the people that came in. We were so lucky that the best and the brightest of Washington in housing, their employers decided they didn't need them anymore. Fannie and Freddie were getting rid of people, so forth, and we were able to take advantage of that, and that was huge, because there's no way we could have transitioned what we went through if we would have had to rely on the people. And again, I'm not disparaging people who were here when I got here, but the upgrade was dramatic, getting the people coming in from Fannie Mae, Freddie Mac, and from some of the other financial institutions within Washington. So that was really critical. We were at that time to have this group here come in here. So I relied heavily on all of them, and they were great. The other person that you may not think much about, and I was told this when I was first became president, they sent us to the White House for presidential appointee boot camp. And the one thing they told us was, make friends with your OMB people. It was true. OMB became my biggest advocate, even more so. Sometimes the CFO's office of HUD didn't really agree that I should sure getting things. It's great when OMB is saying, you should give them a little bit more money. And so I had that. So to me, the OMB relationship was really big to have OMB really understand what we did and the risks we had. And I really appreciate that, and they really were very supportive. And then also also the concept too of just dealing with all the lenders, the Mortgage Bankers Association, reaching out to them, and all the various trade associations to try to create a situation where you have this transparency that you can work with them to try to find some common ground to work on things, as well as the investment community. In talking about Rob talked about going to Asia, it kind of drove home this partnering with the industry was. The last Secretary of HUD that I worked for, Julian Castro, his brother Joaquin is in Congress, and he's the liaison from Congress, or was, to Japan. And Secretary Castro told me, he said, Joaquin's been on me to go out to dinner with the Japanese ambassador in town. We finally went out, and you wouldn't want to talk about Ginnie Mae. He didn't want to talk about any of the grant programs, community development. He wanted to talk about Ginnie Mae. He said, I couldn't get over it. He's talking about the one thing I knew very little about, and that's all he wanted to talk about all night at dinner. But again, it shows the far-reaching relationship you have with the capital markets. So the key thing I think is your partners, and trying to develop your partnerships in the industry is really critical. So those are the things that I thought really got me through, was partnering with the industry, dealing with OMB, and then having a good relationship with some of the best people in the industry here at Ginnie Mae.
Well, I can second that. I will tell you that I spent my first 30 days thinking about and learning about the staff in this agency. I could not get my head around how this $2 trillion business and all the payment flow and everything that happens every month, billions of dollars, 80 billion a month we were hitting, was done with so few people. And so the first thing I did was, I've got to get to know all the people that are here making this happen and understand how we're doing it. It's just top-notch team. I must say that that is truly a gift in this organization that's been left from the legacy of all the great hires, some of them who've been here 35, 40 years. So it's great. Joe.
Well, when you first get here, their staff looks at you like, well, you'll be gone soon. So they really don't pay much attention. But each month, it became more and more exciting. And frankly, the staff really was trying to figure out what the hell is going on. And was this an anomaly, or was this really going to be something that was going to continue? We were getting, I think, Treasury figured out that the monthly increase in volume, the domestic markets really didn't have the wherewithal to support it. So, went to Asia, and we did a lot over in Asia. It was difficult to get the outside world in 2008 and 2009 to focus on Ginnie Mae, so to speak, until I was in Japan. I was in Tokyo in September of '08 when the word came down about the GSEs. And then everybody wanted to be your friend. And I can tell you, and that went from the Asian markets, even the CDC in China. I don't know, Ted, if you did a lot with those folks, but they were big buyers back then with the Ginnie Mae bond program. But when you came back to the States, everybody on the street wanted to talk to you because they recognized that this vehicle was going to be something that was going to be able to support the markets for some period of time. So that's when I think the staff understood that this was a long-term game. They understood that the marketplace was depending on them to get the work done. And I don't think anybody still here that was here when I was here. I think they're all pretty much, unless I'm missing somebody.
They may not be in this room, but they're.
Yeah, okay. Well, I meant in this room, but anyway. And so you realize, and then all of a sudden, you didn't have to tell them what to do. They knew what to do. You're kind of just sitting on the sidelines, making sure they're between the white lines. Not getting outside this far. And it became, I think, a real good moment for them to recognize how important the job that they did was to the marketplace. I think they felt very good about themselves. And that was the best thing that happened. So you do build relationships with the marketplace. You do build relationships with the bond buyers. But when you don't have a staff that's going to sit there and do the work every day and get it done, with 69 people and the volume that we had, it was almost impossible task, but they figured it out, and I don't believe we ever dropped the ball. Or they dropped the ball, let's put it that way, because I just came in every day, had my coffee, and just, But,
so I want to take us to where we are. I mean, the mortgage market it's different. It's changed in terms of the makeup of who is involved in this marketplace, who is doing FHA lending, supporting veterans and the like. The dynamics of the market have changed tremendously. What you've all touched on a little bit in terms of the importance of the global relationships of Ginnie Mae, stands true. That is a huge component of our holdings at this point. And we are spending a lot of time building those relationships, and the pandemic has made that very difficult. So we've had to find new ways to communicate, engage, and ensure that the value proposition of Ginnie Mae and our guarantee remains viable, and that they understand where we're going and that we're staying relevant. Because we're just a choice of many choices at this point. This is kind of a volunteer army that works on our behalf, and so we are constantly trying to think about ways to ensure that the value proposition stays strong. So with that said, I'm just curious, with the way that the market is made up now, what do you see as the biggest risks or biggest differences from the risk that you managed when you were managing here at Ginnie Mae? And what concerns would you have and would you share with the team, and things to kind of think about or look out for, or would just love to hear your thoughts on this.
I personally think that too many organizations got started during this time when it was easy. A lot of these folks in the business today have never been through a rough time. A lot of these folks in the business have not really focused on their liquidity. And I think it's starting to happen, and I think it will continue to happen. We're going to have a shrinkage of mortgage opportunities. But when you look at an issuer, depositories are a lot different than non-depository issuers. But the message that I always try to get across to them is, it's not a right to be a Ginnie Mae issuer, it's a privilege. And whatever you do, you have to protect that privilege. And I'm not so sure that everybody understands that that's the game. There's nothing more important for you to be able to have your own liquidity, create your own bonds, and boy, it's there, it's there, it's there. But if you screw that up, you're going back to the dark ages with your organization, and I think that's an important thing that people have to realize.
Elena, we are in a difficult situation with the inflation and housing prices, and the Secretary mentioned to us that the affordable housing is key. And, I think staffing is very important, and I would encourage you to pick good people, and staffing is integral to your future of Ginnie Mae. And I also think technology is very important, and I would encourage you to emphasize technology as well.
Ted, do you have any thoughts on the market and risks that we face in this environment versus you're closest to the current state, so.
I mean, we went from a situation when I came to Ginnie Mae that there were 5 issuers, all banks, controlled 2/3 of the business. So it was very concentrated. So it wasn't just bank, it was concentrated. And then we went to the point where those 5 people basically wound down or got out of the business. So we had the independent mortgage bankers started becoming issuers, and we had kind of more of an even spread. All of a sudden, nobody had more than 5 or 6% market share. It was pretty even, but what's happened now, we've built that back up again now. So now there are mega IMBs that are literally too big to fail now. And so the risk that I see is we went from a situation where we had IMBs that were small enough that we could deal with consolidation from the standpoint somebody got in trouble. Now we got the massive IMBs that there's no way that you could actually try to deal with them in any kind of a situation where you transfer the servicing to another issuer. So I think that's probably the biggest thing that I see, because you still have all the issues around the IMBs not be able to raise government guaranteed debt like banks can through so they don't have access to deposits. But now you've got these extremely large, and they're really extremely large when you consider that when I was talking 2/3, it was 2/3 of 800 billion. Now we're talking half of 2 trillion. I mean, the numbers are bigger than they ever were before either. So from that, so that's kind of what I see right now as the big challenge, is really trying to make sure that people realize that Ginnie Mae needs the resources to be able to evaluate and understand the risks that are out there. Because another issue that we had was the IMBs came into the IMB space. Their balance sheets were different. I mean, if you're a bank, it's pretty similar because everybody's regulated by the FDIC. You come to IMBs, they're all different. Some have capital from private equity firms. Some of the capital has to be returned in 5 to 10 years. Some of it's permanent. Some of their people are state pension funds. It's all over the place. So to me, I think the biggest challenge you have right now is Ginnie Mae probably has, I think, probably the most sophisticated counterparty risk in the government. Because you talk about FDIC, but FDIC, they're all banks. I think Ginnie Mae, because of the IMBs and the creativity they've had to deal with, since they don't have government guaranteed debt, that creativity, I think, is great for the industry from the standpoint it's brought a lot of people in. But Ginnie Mae's sophistication in analyzing that risk and staying on top of that risk is critical. So that's what I think right now is that the biggest challenge I see right now is that the IMBs are there. And again, I want to stress, I don't think there's anything wrong with IMBs. It's just more the fact that they are entrepreneurial and they tend to be more creative. But Ginnie Mae needs to be able to understand the risk and be able to deal with it accordingly. But the key is not to over-regulate, because you over-regulate, those costs go right to the consumer. So Ginnie Mae needs to have the staff because if you don't have the staff, you're going to have to overregulate. So you need to explain to people that the way to keep regulation to a minimum is to give them the resources to be able to deal with that risk accordingly. So that's what I see right now.
You know, one of the problems too, I think that you're going to have to deal with is if you have an event that occurs, it's not easy to convert an MSR. It's not easy to trade it, and it's not easy to liquidate it. It takes too much time. We have to be looking for those who can give ways to be able to expedite the MSR process, whether it's being bought or sold, or whether or not it needs to be liquidated because you need to be able to liquidate a portfolio or whatever you might need. But that's a real problem, because getting access to that liquidity through an MSR, I think, has always been difficult. But I think it's going to be more difficult if we have another event that might occur.
That's a great point.
I'm gonna play the counterpoint here to a certain extent, although it plays into what Ted says. But keep in mind that if the IMBs hadn't stepped up when the banks backed off, where would Ginnie Mae be? And I grant you that there are certain risks there, but I think, and I'm looking at Greg Keith right now, but I think to date, the biggest loss in the Ginnie Mae portfolio is still Taylor Beatty and Whitaker, right? Well, that was fraud. That was different. Yeah, that was a different set of,
Right.
set of
Circumstances,
risks.
right.
When I was president of Ginnie Mae, the minimum net worth requirement was $250,000. And I know that there's a discussion now about trying to raise, not just Ginnie, but Fannie and Freddie as well, the minimum net worth. It is important to always keep in mind, in my view, that the credit risk, which is the major portion of the risk in the mortgage transaction, is already covered for Ginnie Mae. It's the liquidity risk that has to be taken into account. Obviously, it goes beyond that, because in those instances where Ginnie Mae has to take back over a portfolio, there's some operational risk in there as well. I don't want to downplay the risks, but I think there is a huge risk in being too risk averse. I mean, if you want no losses, make no loans. That's not what we're about.
Right.
We're about making loans and increasing home ownership, and IMBs are a very important part of that. So I caution Ginnie to be very careful. Now, could banks come back in and play a bigger role? I think that's true. I mean, the market share flipped totally from, I think it was at the time that the False Claims Act took its toll on bank participation. Banks had about a 70% market share. I'm looking, Leslie's now nodding her head. Today, that market share, bank market share, is now in the 25 to 30%. Roughly. So surely there's a happy medium in there, but still, I don't think there's anything to be gained for homeowners by discouraging independent mortgage bankers from participating in the program.
You can accomplish that, though, by the what ifs. I mean, you know, when I was a young guy in the banking business making loans, I had to make a loan based on I knew I had to collect it if something went wrong. So you're always looking at the what ifs and how are you going to go about collecting it. I think the same thing applies when you're looking at an issuer. The what ifs, you know, I mean, is there enough liquidity there to cover off? Should it, let me ask the question, should all new issuers be able to retain MSRs? I mean, is that something that need to be thought about? I mean, the guys in the office that do the credit, I mean, is that something that is feasible to think that, you know, you're kind of marginal, but you really shouldn't be able to hold these? I mean, everybody thinks it's easy holding an MSR until it's time to pay the piper. So, you know, that's just a question I've always had. Is that feasible? I don't know if it is or not, but I'm looking at ways that you can minimize risk and still get the job done.
But again, I guess my point is, if you don't want to hold the MSR, you should work with the aggregators. I mean, the question is, not everybody needs to be a Ginnie Mae issuer. So my question is, if you don't want to really hold MSRs or service loans, sell to a PennyMac, Wells Fargo, whoever it might be. I mean,
that's an
the question.
alternative, sure.
Yeah, and that way, and then getting back to Rod's point, I'm not knocking the IMBs. I think IMBs are critical. My point is, Ginnie Mae has not gotten the support it needs. That's what I was getting to. That I think the IMBs are in the game, if not forever, for the foreseeable future. But Ginnie Mae is still being treated as it was 20 years ago when it was bank dominated. I mean, look at the number of people at FDIC. I mean, you think Ginnie Mae's got 430 issuers. Unless I checked, I think FDIC has something maybe like 1,300 banks, 1,400 banks, but they sure got more than 3 times the Ginnie Mae staff to stay on top of their banks. So that's the point I'm trying to get to is if we make the assumption that IMBs are going to be around, which I think is a very solid assumption, give Ginnie Mae the firepower and the horsepower to be able to understand it. So because again, they're getting back to your point, Rob, if you're in a situation where you're understaffed, the best way to regulate is make it tight. I mean, you make it so tight nothing goes wrong. But you don't want to do that. You want to get to the point where you have the staff so you can understand all the various organizations, their strengths, their weaknesses, and be able to tailor your programs to those individual IMBs. But when we do that, you got to have the resources to do it. If not, it's got to be one size fits all, which doesn't help anybody out because one size fits all means it's too restrictive. And that's where I think that we really need to find a way as an industry to get people to understand why Ginnie Mae needs to be more than 200 people. I mean, it's ridiculous. It should be 600 or 700 people based on the risks that it's holding. And I think that's where I think it's the big misnomer, because again, like Rob said, IMBs bailed out the industry when the banks pulled out. They're a critical portion, so let's acknowledge it, and let's acknowledge that they need them. We used to talk about Ginnie Mae about trying to have a situation of trying to get ahead of an issuer when they get into trouble, to work with them, to counsel them. Well, one way you get ahead of them, work with them, is you got to have the early warning systems that enables you to get out ahead 6 months, a year before you hit the wall with liquidity. You can't wait till they blow up before you get involved. And that's where I guess I would just encourage you and the industry to really work on getting Ginnie Mae the horsepower that they need.
I'm sorry, go, Ronnie.
Please go.
I was going to suggest that you be very careful, extremely careful, about ideas to change Ginnie Mae in one way or another. They may be well-intended, may not be so well-intended. It may be self-serving, it may not be so self-serving. But I think we have to protect, as I think we have to protect the institutions of our country from change, because that's what holds us together as a society. I think we have to protect the core values and core processes of Ginnie. If we can improve them after careful analysis, fine. But don't just jump into something because some maybe influential group says, well, this will help home ownership, it'll help, whatever. Be very cautious. You have a great thing here. Keep it great.
Great advice. Any final comments? I'm going to open it up for a few minutes of questions if there are any in the queue. I think there will be mics coming around if anyone wants to jump in on the conversation. Queue up your question. One thing I wanted to say first to Ted, I did not plant those comments in Ted. And we are so appreciative. There are many on the staff and our leadership team that are here in the room that we've been thinking, the constraints are real and the possibilities of what the future market holds or the default of an issuer and what that means and the capacity it takes to be able to do that work. We have some serious constraints there. So your points are much appreciated on staffing, on support of the budget and resources we need, and being able to ensure that we have the tools. Our risk management team is building state-of-the-art tools to try to manage, but we can only manage so much with the limited resources we have. And so I think it's really just crucial. The technology points that you made, the staffing points, and the budget have to come to join us here in a $2.1 trillion world. And we're not quite there yet, and we have a lot of work to do on that front, and the team is really focused on that. So I appreciate those comments.
Well, I guess what I want to put in perspective, people to realize, we talked about Taylor Bean a few minutes ago. Taylor Bean today is a drop in the bucket. Yeah. It was $35 billion. That's rounding. I mean, just put in perspective, an organization that turned Ginnie Mae upside down is now I don't think it's even a top 10 or top 20 issuer, maybe top 50 issuer. They're only 35 billion. So again, to put in perspective, we're in a whole different world than we've ever been before.
Agreed.
And we've been lucky in the fact we've had home appreciation. So the credit risks that Rob talked about are minimal.
Right.
But I still have to disagree with Rob. There's still a lot of credit risk because with curtailment of claims from the FHA, the False Claims Act from FHA, VA's limited guarantee, there's quite a bit of credit tail risk. It's not as bad as the GSEs, but it's better than what a GSE servicer has. And I think we need to keep that in mind that there are credit risks because none of the government agencies cover 100% of the credit losses.
So
It sounded like the secretary, though, today was in a much better relationship with you and Ginnie Mae than I've seen from other secretaries that we've worked with in the past, where you might be able to get some of that done based on her appreciation for what this team does every day.
Yeah, I do feel fortunate. As I said, I feel like one of the luckiest to have such close coordination and collaboration with the secretary. I'm very, very, it's a blessing. And so one last thought just on this point to close out risk. There's currently active rulemaking. We just had a joint session with FHFA on the capital and liquidity around, and particularly for Ginnie Mae, the risks around non-banks. We have a lot of input that's come in from stakeholders. It is really about what we're talking about, which is how we manage what is an incredible dynamic in the event of a default of an issuer, and we're moving into a market that is vulnerable, and there's a lot of volatility. So this is something we're watching closely, and we really do appreciate everyone's input to the capital and liquidity requirements, what that should look like as we move it forward. And the team is really working hard, and I'm proud to say, in partnership with the Federal Housing Finance Agency, really understanding our differences and appreciating those, but also understanding the need for there to be synchrony, harmony in that, because we're talking about the same set of stakeholders and issuers and servicers that are impacted by anything that either of our agencies do. So thank you, Sandra Thompson, who is also in the audience. I appreciate your partnership on that as well. So I'm going to see if I think we had a question or two in the audience. Yes, ma'am.
Thank you. It's great to see all of you, growing up in the business with most of you. Here's my question. The IMBs have played a vital role, as Ted said, when the banks left, and Rob's mentioned be careful with what you do there. With the OCC and their top banks, they do a good job with custom oversight and kind of regulating and oversight of the banks, and they're all unique. And it feels like your IMBs are going through the same thing. They're pretty sophisticated, maybe all of them. Some are better than others, but you don't have the staffing, it sounds like, to just do that, oversight, but not necessarily has to be one size fits all, because they're all pretty different and their funding vehicles are different. And so two things on the funding, Ted, you talked about funding for 8 years. I mean, you worked hard to get funding and it just didn't help. So how can we be helpful in the funding effort? And then just, can we get these banks back in to help level out? I mean, we should all make a little bit more of a collective effort. And what's the false claims? I mean, we've been talking about that for a long time. So those would be my two observations of funding. And then what can we do to attract the banks to this really great market?
So I'll just say generally, and then I want to hear your thoughts too, especially about bringing banks back into the program. I think the secretary has been very focused on this issue. She understands the imbalance. She understands the risks that are there and inherent with the makeup of things right now. The banks are in the business in different ways now in terms of their support, for liquidity support and other supports that they provide to the IMBs, many of them, and there's a lot of other ways in which they are participating. There's the Community Reinvestment Act modernization underway. We have been talking about some opportunities for secondary market in the context of the CRA. I think there are some real opportunities there if we could make those incentives possible for banks to bring them back. through, either on the investment side. And so there's some proposals and ideas that we're shopping and ways in which we're thinking about how to attract the banks back to the program on our side. And FHA has obviously a lot of work to do here. I'm looking at a special guest in the audience as I think about this in the future. FHA has a lot of work to do in terms of getting the False Claims Act and those risks. And I know that the Secretary is committed. She is, speaking and spoken to DOJ, and so they've really been some good dialogue around that and some of the potential ways forward to make that issue, silence that issue. It is really in practice kind of a thing of the past. It's not as it used to be. Did anyone else want to comment on the banks? How do you bring banks back?
I mean, again, back to your point, the issue you're running into is FHA has got to step up to the table in a couple different ways. First of all, False Claims Act. I don't know how you deal with the False Claims Act without changing the law, because administrations can come and go. So 30 years is a long time. And so the question is, they need to get through Congress, and they also need to get a lot of the congressional support to not treat lenders as evil. I mean, when I was in administration, we tried to do some things to try to change some of the wording in some of the attestations and so lenders have to go through. And a lot of the progressives and the Capitol Hill fought it. I mean, the idea is that they just don't get it. The idea that lenders are not evil. The lenders are the partners. They're the delivery. And so I think the concept's got to be is, I think it's going to need congressional action, I think, for lenders to feel comfortable. And then also, too, it's a situation where FHA has also got to become more nimble, because the concept, at least my recollection when I was a lender, was that FHA would just criticize you when you did something, even though you meant to do right. I remember I used to tell Brian Montgomery when he was FHA commissioner during the last administration, FHA is all about process, not about outcome. They don't care whether the guy you lost money or not. Did you fill out Form 2565 properly? And if not, we're going to penalize you. So FHA's got some major, I think, overhauling the way it looks at stuff to really get the banks back in, because they want surety. It was kind of like one major CEO told me, one of the big 5 banks, like I mentioned, that controlled that were going to get out. He said the CEO of their holding corp told him that he can get back in FHA if he can tell the CEO that he'll never lose money. Because his issue is, I'll support FHA because I think it's great for CRA, but you got to give me some way of telling me that you've priced all the risks properly. If not, I can't be left hanging out there swimming around. So again, I think that's you got to get banks back. You got to tell them exactly what they need to do, give them safe harbors, and not second guess them. I think that's what you got to get. And I just don't know if the secretary can do it herself. I think it's going to probably take congressional action, so it goes from one administration to the other. Until you do that, I don't see how the banks are going to come back. Plus, I don't know if the banks are going to come in a big way, because banks have tended to be fragmented in their product lines. I mean, they're doing mortgages, credit cards, all this stuff. Well, today, the investment you need in technology is so dramatic that the question the bank looks at is, do I put money in mortgages or put in credit cards? Put in auto loans, do I put in? If you're an IMB, you're a one-trick pony. So it all goes into mortgages. So I think in some ways with the technology revolution, I think banks may be out forever, because they're going to look at the return on the capital they need to put into mortgages for all the technology that's needed. I think they're going to find they got better places for their capital than mortgages. That's my speculation right now.
And I would just say, I don't think banks are out for, I think banks may be in different ways in the future. And I think we have to really start to recognize that in our larger policy conversations, like CRA and other ways in which they can contribute or take part in the market. So, David, I see you have a question. Did you want to get a point in, and then I'll.
I always want to get a point in.
Yes, go for it. Go for it.
First, Faith.
Faith did a great job for me at the Housing Policy Council as Hope Now.
We're all Faith fans. We're all Faith fans. But I would like to point out that all those independent mortgage bankers are regulated. They are all regulated in the various states in which they work, as well as on a federal basis. I'm a little unique in this panel, because not only was I Ginnie Mae president, I was also general counsel of HUD and also president of a bank. And when we looked at the False Claims Act, the people in the general counsel's office at one time thought it had no application in this process. So to say that the False Claims Act is something that requires a change in law. Now there's a memorandum of understanding in place now between HUD and the Department of Justice that I think deals with a lot of the uncertainties, because as a bank president, I can tell you that the one thing that you don't want is the uncertainty. You do not want regulation by enforcement where you don't know what the rules are. Bob Brooksmith's in the office. He's the CEO of the Mortgage Bankers Association, and without fail, every one of his members will tell you, if you tell me what the rules are, I will play by the rules. Right. So to the extent that you want to bring the banks in, I will caution that the uncertainty that comes with regulation that's not clearly set forth causes people to flee the market. And let's keep in mind that the reason we're all here is because we want more home ownership.
Right. So that's right. David.
This is great, and some of my favorite people are sitting up here, and the rest of them are in the audience.
Hey, David.
So nice group, hey, Rob. I would say just on this point, because I'm not going to be a broken record on False Claims Act, which everybody's tired of hearing me talk about that, but the bottom line is that in any form of regulation, whether it's at CFPB or FHFA or Ginnie or FHA, the less clarity you have, the more overlays you're going to have. It's all about the credit overlays. Not everybody's going to leave the market like some of the banks have, but they will overlay on credit. And you and I have worked for a long time on expanding black home ownership. That is not going to happen if we're pushing into a tide of credit overlays. And so we have to remember that there is a regulatory burden budget that we're spending when we look at these issues. And we have to be careful about how we spend it, or we're going to be paying for it with equity, with political equity and racial equity. The other thing I would just ask some of you here who are older than me, which is many of you, but you have experience with interest rates in ways that I don't, is you were looking at, over the next 18 months from the lows, we could have a 400 basis point increase in interest rates. That's enormous. It could actually be higher because we were starting at 3 and we're near 6 now. And so you're pretty much halfway there. What does that mean for Ginnie Mae? Where's the risk in that? Anybody can hedge 200 basis points of interest rate risk, but when we're talking about 400, 500, 600 basis points, what does that look like in terms of your volume, the risk for your counterparties, because it's here.
Anyone want to take a stab?
I mean, the only I can really talk about is this my time in the business since the early 80s to now. I mean, I think Ginnie Mae, the whole industry is going to be slower to some degree because refinances disappeared. I think you have tremendous pent-up demand for homeownership, which means that you're probably still going to have a decent amount of activity. And Ginnie Mae will probably do better than GSEs because the ability for people to accumulate a down payment in today is really tough because rents are so high. So low down payment programs become really the critical piece, which means FHA should hopefully be the beneficiary of it, but I think volumes are going to fall. But from the perspective, as long as the economy stays relatively strong, delinquency shouldn't be all that bad, even with rates going up. So from that perspective, MSR should become very valuable because prepayments aren't going to happen, so it actually could be somewhat positive, except for volumes probably will be somewhat, will be reduced because you'll be down to just really a home purchase market from I guess my perspective, because the key thing is how the economy does. If we go into a recession, all bets are off because at that point it's going to get really interesting because that's when people are going to have to figure out how they're going to put the cash make the mortgage payments. But as long as the economy stays relatively strong, I would think Ginnie Mae will do well because it's got its portfolio. Services will do relatively well because delinquencies will be down, which means its cost of servicing won't be through the roof. So again, so I think interest rates themselves are not that big of an issue, except for the fact that volumes will slow because refinances won't be there. But I still think home buyers are going to be there because you got sky-high rents and sky-high home prices. They got to live somewhere. So people are going to be buying homes because it's not like you can say, I'm going to stay in my rent in my apartment with increasing my rent 10% a year. They're going to be looking to try to buy a home. So I guess.
And we have the additional leg on the stool of housing affordability and home price appreciation, and that we have a housing supply crisis. We have no supply, especially at the affordable end. So the demand is there, but the supply is really constrained, and that's going to continue to be a major factor, I think, in this, alongside interest rate risk.
I just think the psychological effect of interest rates rising is going to have a lull psychologically with people. I mean, most of the folks that are, especially first-time home buyers, are like, holy hell. They're so used to 2 and 3%, or 2.5%, 3%, that's going to cause a pause. But I'm more concerned about the inflationary rate having an impact on wages and their buying power. That's going to, I think, going to be the key to me as to whether or not, whether you're renting or whether you're actually living in a home today. That's going to be, because you're already hearing people can't keep up. If the wages are going up 4% and inflation's 8%, they're going to hunker down. They're going to just try to survive. So I think we have to take that variable and look at that variable independently than we're looking at interest rates rising by themselves. David.
I think we have the last question, and then we're gonna wrap. So please, thank you.
Thank you, Elena, and thanks you to the decades of great experience we have here. The industry and all Americans appreciate your service. I am completely overstimulated, and I could speechify for 15 minutes. I'm going to try to ask a quick question. As you think about liquidity requirements for Ginnie Mae issuers, would you think about changing the demands on those issuers by capping the advances after 4 months, as say Fannie and Freddie do, which reduces the requirement for liquidity, not to let servicers off easy, but just to make it more in line with the GSEs, which would also, by the way, help attract banks back into the space. So it's something, of course, we're making an official, or we just did in our comment letter, but I wonder if any of you up there have a view about whether that might be a good enhancement, because as you know, the full faith and credit of the U.S. government is behind those advances, but it could take 1.5 years for the servicer to get them back.
Well, I guess my answer to that is I guess if we're going to do that, then I think the question comes back to not so much Ginnie Mae, but FHA. Because FHA is the insurer, not Ginnie Mae, on the individual loan level. Because what you're saying, a borrower after 4 months, so the question comes back to, should FHA be doing a partial claim? Because you think about it, Fannie and Freddie are acting as an insurance company on their end, that they have these servicers that are servicing for them, and they're capping it out and saying at that point they'll step in. So my question is, because I think Ginnie Mae's the last person to be involved in it, because Ginnie Mae's role is not loan level. It's truly a situation where Ginnie Mae is in the same role as FHFA. Ginnie Mae, when you think about it, Ginnie Mae has 430 Fannies and Freddies. So the question I guess I have for you would be, would you go to FHFA and ask Sandra Thompson after 4 months, will the federal government step in to make all the payments for Fannie and Freddie? Because liquidity, and I guess that's the question I have, is getting back to Ron's point, you're talking about a fundamental change, because Ginnie Mae's role is simply to guarantee the debt obligations of the issuer. That's the beginning and the end of it. It's not involved in the actual servicing of the loans. That's FHA and VA's bailiwick. So the question is, should FHA and VA bail them out as far as giving the liquidity, or should it, again, that becomes, I think, an interesting question. But Ginnie Mae's role at being an FDIC-like organization, it really isn't really their role to really step in at loan level to do anything. So I guess that's an interesting question for Secretary Fudge to say, would FHA, because when I was in the Obama administration, I remember one time we were talking about some of these issues of advances. I remember the Secretary turning to the FHA Commissioner and saying, what are you going to do about it? And they was like, because I threw out this concept of the liquidity issues and the challenges, and the Secretary understood that was really FHA's role, and the FHA Commissioner basically shrugged his shoulders when he asked, well, what are you going to do about it, when I explained the dynamics. So it's a good point, Bob, and that would be my question. Would FHA and VA be willing to step up and do partial claims or something like that after 4 months, which I think is really critical. We learned in this go-around, having 4 months of forbearance, then having partial claims, because that's one of the things I've been trying to talk about now is, why don't we make the partial claim process permanent? Getting back to your point, after 4 months, you forbear for 4 months. If the guy's still delinquent, get him current and throw it on the back end of the loan. I think that makes a lot of sense on everybody's part. So I think from that perspective, we should talk about it.
One last word.
How much liquidity should a Ginnie Mae issuer really have, though? I know you guys are working on some capital issue right now, I think, unless I read. But how much should they have? I mean, believe me, when we were in office, going from 250 to 500 was like I was asking for the firstborn. Okay, that was number one. Number two, we weren't even tracking the ability, how much liquidity the issuer had. So I guess the question today is really, how much of that balance sheet is really liquid, and how much does Ginnie Mae think that any issuer should have in that position? So that to me is a question you all have to wrestle with and answer.
It's definitely the issue du jour,
Du jour.
at the moment. Thank you for the questions in the audience, and thank you all. I just want to close us out and say thanks to the team in this room. There is Ginnie Mae's leadership team and multiple people who made this possible. I walked in like a month ago and said, or 2 months ago, and said I would love to hear from every possible Ginnie Mae president we can get in a room. Let's try it. And here we are. So I'm just so pleased, and I want to thank Diane Cooper, Smith Avasant, and so many others that really made this day possible. Please do stay connected to Ginnie Mae. As you can hear from we're touching the surface here today on the issues ahead, but we do have a lot of work going on. We've just updated our website. We're trying to really stay connected. The pandemic meant that we had to figure out better ways to communicate and technologically get our message out and make sure people are staying connected. We really do value that. It's very important. It's in my DNA. I come from the Urban Institute, and then it's in our DNA to try to stay relevant, but also when we have data and information and analysis insights. We have a new blog on our website. Please check that out, and you'll get a chance to get a replay of this if there's anything you want to hear again. And I just want to say thank you again. Much gratitude for all of the wisdom that you all have shared here publicly and privately with me, and the encouragement and support, because I know that it does truly take a village to do what we're doing, and also to really make the strides ahead and in this big time of transformation, which is a major part of our agenda going forward. And there's so much to transform in support of the American people, homeownership and affordable housing and rental. So thank you all for joining us, and please join me in thanking our esteemed past presidents. Thank you so much.